idea here today is to just share how at least I think about these deals when we are making the early stage investment. So there is a particular structure that is there in our mind, which is slightly, it's kind of it's taken it some time for it to settle down in my head. But now I think it is pretty firm in my head, and I'll kind of walk you through that. So if you can change the slide. Yeah. So basically, yeah. So when you get a deal, how do you think about that deal? So basically, there are multiple aspects to it. We talk about who is doing it, right? What is the founding team like? There are a lot of dimensions to that, which is whether people have experience, pedigree, done startups in the past, but there is a founding team dimensions to it. Then depending upon how early it is, there'll be a dimension around what is the response that they're getting, and then what is the market size, this is big enough opportunity or not, and then will this venture scale, how they're kind of doing it, and what is their moat eventually, will they be able to protect it and stuff like that. But that is how kind of these are the aspects of it, but I like to kind of further simplify it into three dimensions in the next slide. Paras. Yeah, so I think it just boils down to three things. It is basically around product, market, and team. And then when you think about it, right? So it could be a great team working on a great product in a market which is just ripe for disruption, and that is like that is the holy grail. If you're able to get all three right, then that is nirvana. Problem is, almost always you do not have all of these three things happening for you. So then the question is, what is it that you bet on? Do you take a bet on the market? Do you take a bet on the product, or do you take a bet on the team? Um, and then the question is, right, even if it's a great market, people have come up with a great product, if the team is not right, it will not work. And that is correct, right? If the team is right, but they're not able to put together the product sucks, it will not work out. That is correct, right? And if the market is not right, it's a market that is just not moving, it's over-regulated, it will not work. That is also correct. So the question is, out of all of these three, if all of them is not an option, and then you have to choose one, what do you choose and what is the thought process? And that will actually give a lot of insights into how do you go about making angel investments. So I think over time and again, what has proved to be the key differentiator has been the right market. If there are markets which are large and which are going through some kind of a structural change. For example, there was a structural change that happened recently in India around the whole payment stack, which was facilitated by the whole UPI that the government enabled, right, by getting all the banks on board. And what that did was unprecedented. It was unprecedented in the whole world. And the entire market around fintech got disrupted because of that. So it was a great market to be in. So I think when we're kind of looking to make investment, we should think about that as a choice of market to make a bet. So similarly, there are some other markets which I am very excited about, and which I think are right for India. For example, the education market is like that. So education market is going through a structural change at this point of time. So, and kind of, I'll help you visualize that. Um, so because now smartphones people have, and internet speeds are there, and it's also very low cost, what you see is the way we used to think about delivery of education is changing. So we used to think about sending our child to a teacher nearby for tuition, and we were not optimizing for quality of education. We were optimizing for, the logistics of it. The logistics of this market has changed on the internet. So this is a large market which is going through structural change, and there will be great companies coming out of it. So as angel investors, we need to take a bet in this space, right? And I'm not saying for a minute that team is not important. What we need to, the way we need to think about this problem is that we need to choose a market where action is going to happen over next 3 4 years because of some structural reasons, and we have to put our money behind a good team in this market with the conviction that this team will be able to iterate and find the right product which works. It will that product when we are evaluating, and then what we have to appreciate is where we are in the food chain. We are coming ahead of the venture capital, and venture capital is also kind of moving down, and trying to kind of come in early. So these guys are running early stage programs. Sequoia is running Surge. The other people who are trying to do seed investments just to create more funnel for themselves. Let's Venture, and we angels as part of the Let's Venture platform, we like to come in before them. So a lot of times the product will not be ready. It will just be an idea. But what we need to evaluate is this idea is in the right market, and is the team capable. And then in our heads we have to imagine that, okay, uh, this is how the product might look, and this team is capable of putting that together, and we can pull the trigger. I think that is the mantra in short in my head about how this entire thing works the best. So we can go to the next slide, and then feel free to kind of ask questions in the and then we can keep it more interactive that ways. Um, so yeah, so basically, yeah, when it kind of now let's just once with this in place, if we are looking at the specifics of a deal, then I think on the AngelList platform sometimes, as individual angel investors, the deal flow is not there. What Let's Venture is fundamentally doing, it is kind of making lots of deals come our way as a platform. And what therefore then matters is how to evaluate the deal which is there on Let's Venture platform. So of course you put the market filter, you put the team filter, and maybe a little bit relaxed about where the product is at this point of time, hoping that it will catch up. I think one other filter that we can have is, yeah, that we can have is basically who's the lead investor, who is leading it, what kind of deals has he been doing, what kind of track record he has. So all of those things matter a lot on the Let's Venture platform, just because this way it has been structured. And I think the other thing that matters a little is valuation, and we'll talk a little bit more about valuation. See, as angels, if you are kind of getting it at a very high price point, it does not make sense. But at the same time, the other thing is that so while Let's Venture platform is more cognizant about these things, what I've seen is some deals where angel investors came in early and they now own like 25 30% of the company. What that does, it leaves too little for the founder at a very very early stage for him to be excited about in the long run. So while the sometimes angel investors cease to be angel and then kind of try become too greedy, I think that does not work for the companies, especially in the venture space. So I have seen companies getting recapped by later stage investors, where everybody ended up taking a haircut to make room for the founder. And I think that is completely avoidable. So we need to figure out what is the right valuation in which we should invest in, because if we invest at too high a value,
Just a
yeah,
moment, Pallav, requesting everybody else to keep their microphones on mute so that this is fluid.
yeah,
Pallav, you can
continue.
continue.
Okay, great. So then I think the other important thing is that we need to look at how long will the money last. So there are companies, depending upon the burn rate and what they want to achieve, we need to work backwards from there. That we were coming in as the um, angel round in the company. What we need to figure out is this money that the company is taking now, how long is it going to last? Is it something that what kind of metrics roughly will the company be at by the time the money is running out? Because if we think the round is too small, the company will again be in the market raising another round, which will be dilutive not only for the founder but also for the existing angel investors. So I think just getting a back of the envelope handle around it is, I think, important. And I think due diligence is, of course, one part that gets done, and Let's Venture can kind of takes care of that for us. So we, as individual angel investors, do not have to get too much into it, and Let's Venture kind of takes care of the legal and the financial part of it. These are also some rough valuations, kind of a cheat sheet for it. So typically, depending upon seed round, angel round, Series A and Series B, these are the typical uh, amount of kind of ticket size that is raised. Seed is typically raised from friends and family, or there are a lot of accelerators who take like a 6-7% stake in the company and kind of, but it's about 100K amount. And then when you talk about angel, which is what people end up raising on Let's Venture, it is typically in the range of $500,000. So about 3.5 crores, sometimes even lesser. But and that happens typically with a 15% kind of a dilution number. So that is the kind of range that we are operating in. And then the expectation is that when the series, by the time Series B happens, uh, and then different people have different philosophies around it. My philosophy, which is slightly biased towards kind of closing the loop and exiting. So I typically, for my angel investments, I exit at Series B, and I would like to talk a little bit about it. And this is very, very personal opinion, and this is what I kind of tell people in my syndicate as well. And the thesis is that and then you have to kind of appreciate this a little. So what happens is that in India, when you look at people who have made um, companies which have exited, you can kind of literally count it on your fingertips. That like very, very few companies who have actually returned the money back in entirety to the investors. So the journey is long, and then the venture market is flourishing in India for like almost about a decade now, but the money has not come back home. So now what happens is uh, we come in as angel investors earlier on, and then Series A guy comes, Series B guy comes, and this, we are talking about companies which are doing well, and then the Series C guy will come, and the Series D guy will come, and we are, as angel investors, at the bottom of the liquidation preference stack. Now imagine a company which has got to a valuation of almost like a $1 billion plus, and it raises $100 million round, it dilutes at 10%. Now, and after that, it does not go, or maybe it raises $200 million from SoftBank. And after that, it is not able to perform well, and it is struggling. And the company ends up getting sold for like maybe $250 million or $200 million. The angel investors get zero. So despite having a company that went to a valuation of like $1 billion, the returns evaporated. So imagine, and then this is not something that is unprecedented in India. You can look at a company like ShopClues. You can look at a company like Jabong. At the peak of the excitement around these companies, they were worth over $1 billion. That's a lot of money. But people who wanted to, kind of keep getting more money out of it, eventually did not make money. And while it is okay for venture investors to play this game, because what they're able to do is they're able to keep, every time when the valuation goes up, venture guys are able to exercise their pro data and keep upping their stake in the game. That is not true for especially for angel investors. So what I recommend to angel investors, and this is again my personal thought process, is that angel investors should look at exiting at Series B. And I've been able to get my syndicate guys exit from now two companies. One is Docquity, another is Class Plus. Class Plus Series B has not happened, but we came in very early. So on a Series A evaluation, we exited. Not because the company is not exciting. What we felt was, we have delivered like a almost like a 5x return to the investors who had come in angel round. That is good. We can kind of wait for this number to go to 12-15%, but liquidity in private markets, we have to be cognizant that the chances to exit are not always available. So every time, once you have made 5x of the investment or 4x of the investment, we need to be cognizant that if there is an opportunity, we need to think actively whether this might be the right time to exit. And so, for example, I have a friend. He's a very very early stage investor in this company called Practo. And Practo is, at least it looks on the surface, that it is doing exceedingly well. And he called me up and said, Pallav, what do you think about Practo? Um, I said, it looks well capitalized, but I'm not confident on fundamentally on the business. It just has got great investors who have given it a lot of money to make something big. But with whatever little interaction I have with doctors, it appears to me as if the product is not being used in how the company intended it to be used. So if you're getting a chance, why don't you exit? And this guy was getting roughly about 20x on his investment of 5 lakh rupees. So he's getting about a crore. And the guy did not exit. So I chatted up with him recently. He said, yeah, I'm thinking I should exit now, but problem is that offer is no longer on table. So I think this is a dilemma for the angel investors, that, what value to get in and also when to get out. And I would just repeating myself, get it at the right value. Don't try to come in too cheap, because then the founder gets overly diluted. But at the same time, I think once there is 5-6x money, or maybe 7x money, after 20-25% discount, you are taking home 5x. Just take that money and book it, and use that money to now diversify a portfolio, invest in more companies. That is how I think about it. And also, anybody who is just getting into angel investing, I think another rule of thumb is, don't get too excited about any one deal. There there's some people who kind of get into angel investing, get super hot on a deal, fall in love with it, and then they end up putting maybe like 40-50% of their mental corpus into a deal, which I think is a super bad strategy, because the chances of failure, irrespective of how good it looks today, the chances of failure are there. So you need to always break it down into smaller chunks and kind of try and build a portfolio. You will win some, you will not win some, but you will definitely not win all. The odds are against you. Nobody has been able to do it, right? So I think it's not even worth a try. So just break it down into small parts. Let's say if somebody is mentally looking to invest 1 crore of rupees over a period of 2 years, I think doing 10 deals of 10 lakh rupee each is what the mental model should be, or maybe 8 deals, something like that. So that is what should be done. So on the next slide. Yeah. So the model for Let's Venture is pretty interesting, right? So what they've done is, so the angel investing used to happen in a more uh, worldwide, right? In a model where angels would kind of write check, and then, practically everybody will forget about it, but every once in a while people will worry about it, and then they will ping the founder, and after some time founder will get irritated because he's busy running the company, raising his next round, and then different angel investors are kind of asking questions about how the company is doing. So what Let's Venture has done is something very interesting. They have kind of created this model around a lead investor. and who kind of runs a syndicate on the platform. What it does is that lead investor becomes a Spock for the entire group, uh, and he interacts with the company. And then LetsVenture also gives some kind of a support in terms of following with the company post the investment, kind of getting some simplified metric which gets circulated to everybody. So individual investors do not have to worry about chasing the founder and getting a piece of information out. Also, what happens is because people are now collectively there as a group, the cap table does not get messed up. Otherwise, there are like 15 entries in the cap table, so that becomes simplified. And also, the ability to negotiate and exit for this group becomes far more interesting, because now this group collectively can decide when to exit and at what price. So typically, people who are coming in to buy, they're like looking to take a chunky stake into the company, and by virtue of being part of this syndicate that is there. What also happens is, and then therefore, I think the background of the lead investor matters a lot, because lead investor, especially in the deals that Let's Venture is bringing in, the lead investor could be a decisive figure in terms of helping the company sail through. So typically what would happen is, at least for the deals that I bring on the table, these are people that I've worked with in the past. And I end up spending some part of my time in terms of coaching and mentoring these guys, so that they don't make the mistakes that, uh, you know, they don't make the mistakes that I have made in my life. So there's like standard problems, right? So scaling too fast, scaling too slow, how to hire, uh, people not willing to join you, what kind of equity to shell out for whom. So there's standard problems, and there's standard solutions to it if you've kind of gone through the grind. So I think I end up spending some time with it, and therefore, what Let's Venture has done is kind of created, in general, a carry structure for the lead investor. So the expectation from the lead investor is that they will play a role in terms of coaching and mentoring. And this is not only for me, it is kind of across the board, uh, for all the deals on Let's Venture, that the person who brings a deal on the platform is also benefited a little bit financially if the group makes money. So let us say if everybody puts together a crore of rupee, and that becomes like 6 crore rupees. So 5 crore rupees has gotten delivered on the platform. So typically there will be a carry of 20%. So on the 5%, on the 5 crore rupees. So about a crore of rupee will get paid out uh, to the lead, and it will also, a part of it will also go to Let's Venture as a platform. So the whole concept of carry is there, and then there is a option for on Let's Venture platform to also kind of change that carry amount a little bit. So some people will say, what, my carry is 10%, and there's a 5% carry for the Let's Venture platform. Some people would say that there's a 15% carry for me and 5% for the Let's Venture. And I think that is the maximum that Let's Venture allows. This is like almost like a 20% carry. That is also what the venture capital would charge. So in a way, it is similar. The uh, the expectation from the lead is, make it work. By default, if you make an angel investment, there is a maybe a 95% chance it is not going to work. So do whatever. So the expectation, if I participate in a financing, my expectation from the lead is, and I think you guys should have the same expectation from the lead. And then if you're kind of putting some money behind a person, maybe you should kind of reach out to the guy, have a small conversation, and ask him, how will you help the company in reducing the risk of failure? Because by default, all angel investment companies, just by the law of averages, 95% of them are going to fail. How will you reduce the probability of failure? And then build some confidence around the lead, because in addition to what founders will do, I think the lead will also play a small but very crucial role in terms of helping the company thrive. And for that, there is a carry that they will charge. And I think, I personally think it is well worth the effort that the carry, that the lead ends up putting in the deal. There is also a question from Krishna. What is asked is that a syndicate comprises of lead investor for multiple ventures or a single venture. Yeah. So at least the way it works on LetsVenture is that it's a deal by deal syndicate. So what will happen is there are certain uh, investors who are kind of bringing in deals regularly. So they are kind of shown on LetsVenture platform as syndicate leads. And then you can kind of browse through that list and you can kind of follow some of them. So you will get notified when that guy is bringing up a new deal. And then you can kind of also look at the past investments, see that, you know what, this guy makes sense. He's talking sense. So I like him, and let me just keep browsing his deal. But it is a no commitment relationship. Then on a deal by deal basis, you can choose to deal back that guy. And let's say uh, I'm a lead investor. So I'm bringing on a deal. You can choose to put money in that deal, or if you don't like that deal, or you don't like that market, or you don't like that valuation, you can choose not to do it. So there's no obligation per se. So it's very, very flexible on a deal by deal basis. So that is how the syndicates on LetsVenture operate. Yeah. So okay. Yeah. So it's now when you think about it, you know, the one thing that I like to say is always that the future is changing very fast, and the future is not what it used to be. It is very, very different. It is evolving. So we have to, when we're making some of these bets, especially around the market, we have to project ourselves in the future and try to imagine how will this market look like in future. What is it that people will be doing in the future? And it might be very, very different from what is happening today. I think overall the macros of India are very positive. Um, we are now getting into this kind of cycle where we are having now second time founders coming in. So this whole ecosystem, so I remember so I kind of have some vintage around me now, although it is by any means not in the league of the more successful entrepreneurs. But so I started Nolarity in 2009, kind of similar vintage as what Flipkart is. Flipkart started, I think, in 2008. So now what we have in the market is companies that started around that time, and that is time when venture capital was also kind of taking off in India. So people who raised around that time have seen more than one cycles of companies getting funding, a lot of them not working out, a lot of them not working out. But these entrepreneurs have a lot of experience, and then with that experience, they're kind of doing their second venture or their third venture. So I think the overall the kind of talent which is building venture-backed companies, that talent is now a lot more, so a lot more depth in the market. Also, I think there's a big social change that is happening, where um, back in 2007-8, if you were an entrepreneur and doing a startup, people used to think that you are actually jobless, right? And they said, "Yeah, why don't you do a job, work for Infosys?" I think with this kind of blistering success that we have in Flipkart, and then kind of when people, so it's all become mainstream now. So there's a lot of respect around being entrepreneur, and we have very high quality people leaving their corporate careers and becoming an entrepreneur. So that is what is exciting. And I think each investor needs to have his own set of belief around what he's excited about, what he fundamentally believes as a market which is going to go through massive transformation. And I think keeps looking for opportunities around that core belief. It will be, and then I think not only will make money, but it will also kind of, it will be more exciting because you're making money doing something through something that you're excited about in life. Yeah. There's one more question that has come. So it says, yeah, so it says that can the investors on LetsVenture platform invest outside the platform in their personal capacity? So I'll kind of just tell you very quickly how that works. So basically, all the investments. So actually, this whole, this is like madness. The regulation in India. So what Let's Venture has been able to do is been able to work with the government to create a fund structure where, as individual investor, you say, I am now participating in this fund and routing money through that. So all the investments that go in the company go through a special purpose vehicle is created where the individual investor, let's say, is putting 5 lakh rupees. That 5 lakh rupee will go as part of this SPV, and all the money gets pulled into this SPV, let's say 1 crore rupees. And then that 1 crore rupees is then transferred to the company, and a shareholding is obtained from the company, and which is distributed pro rata between individual investors. So that is how the whole Let's Venture platform operates, where each person is investing in their personal capacity. I hope, Prajesh, this answers your question. Okay. So yeah, so we can continue. I would like to also kind of, we have some time to kind of talk about some very interesting opportunities that we have funded recently on Sunstone, and then what happened subsequently. So Sunstone is a very, very good example. So I would say, like, again, right, the most important thing for me when I was looking at Sunstone was the market. So these guys came up and said, you know what, in India, higher education, the formal, in the formal sector is a massive market. We have so many people in India who are doing higher education, MBA. It's mind-boggling. It's a market which is already there. And this market is not working out very well. We think this market can be disrupted by bringing technology. The colleges are not delivering. The people have very low opinion about colleges. Nothing is happening over there. So yeah, it looks like a market which is ripe for this large market, ripe for disruption. You can bring in technology, you can leverage the internet and deliver very high quality stuff. So while the world was, if you kind of are following what is happening in education worldwide, there is a phenomena called Lambda School that is happening in the US, where people are investing in this company called Lambda School and likes of it, which are saying that colleges are not even required. People will just learn on the internet. We will skill them, and then they can go work at a higher paid job. And this company, Lambda School, takes a cut out of the future income of a person, which is, this whole arrangement is called a income sharing agreement. Now, Sunstone guys, they had a very contrary thesis to this. They said, you know what, in Indian context, the formal education segment is any which way is very, very large compared to the US. A lot of people do not go for degrees because it is very, very expensive. In India, while it is expensive, it is not crazy expensive. So people still pay up 4-5 lakh rupees. Their parents will sell a piece of land to get their child to a MBA degree. So this market is massive. And there is also social value associated with being a degree holder. It helps you get married also in Indian context. So we will not disrupt the informal section, non-formal education will disrupt the formal education. So that was the fundamental thesis for Sunstone, was contrarian. So I got very excited about it. I also got excited because not only the market was exciting, I also thought the founding team, which I happened to know from my previous experience at Nolarity, which is a company that I had founded, and also Crownit, which is a company that I was an angel investor in. And this founding team was actually, of Sunstone, was actually working as part of Crownit earlier. So it was the right combination. And we said, okay, right market with a good founding team, it will be exciting. So what they did was, instead of starting from scratch, what they did was they acquired a existing college which was aligned with their worldview. That college was called Sunstone. So these guys had a thesis. There was a company which was working already for 4 years. They acquired that company through stock swap, and then we did a round in that company on LetsVenture. Subsequently, we could also, we were able to raise financing in Sunstone from Prime Ventures, um, and now this company is in very, very advanced stages of raising Series A capital. If that happens, we would already be 5x of the investment amount that we did the first time around in the company. So, and that would have happened within a span of 1 year. So the first valuation when they had we had put in the money was at actually it was at about $2 million. So on the lower side it was there, but we did a small round because what that enabled was to make that acquisition happen. So very, very exciting success story of doing angel investment on LetsVenture platform and taking it to a logical conclusion. Um, so kind of did not talk much about scalability and differentiation, but just to give you a sense, they were doing 300 students they did last year, and this year they are doing about 2,000 students. And the core proposition of Sunstone is, don't pay 4 lakh rupees, 5 lakh rupees for an MBA, just give 50,000 rupees upfront and study intensely for 2 years. After that, whatever job you get, we are going to charge you 10x of your monthly salary. So it is pay after placement, and the company, Sunstone company, is saying, we are with you in this. We will help you get a job, and people are loving it. From In 1 year, they are scaling from 300 students to 2,000 students. Absolutely amazing response from everybody in the market. We think this company can get to 10,000 students in next 2 years. It's mind-boggling. So yeah, so we'll go to the next slide. So typically these are the kind of challenges that you'll face as investors. So you'll not know what is hot in the market, and this is something that LetsVenture can solve for you, because LetsVenture is getting very, very good deal flow, which is kind of typically led by a syndicate lead. So you will get to know, okay, this guy who is kind of quite plugged into this market is backing this deal. And I kind of like this guy. So let me just go spend some time figuring out whether this is exciting or not. So that kind of action you can see on LetsVenture platform. And then what typically, like the problem I described, is that it's not only about writing the first check, but also it's kind of keeping abreast of what is happening in the company. All of that is taken care by LetsVenture. And not only that, it's also the exit management, which is, uh, I think, more important than getting in. So I think getting into the right deals is very important, but also getting out from the right deals at a suitable point of time. When you're getting good, you've pocketed good 5-6x return. I think don't be greedy coming out, and that is also a process in terms of finding a buyer, striking a deal, and coming out cleanly. And that is also because now we are investing as a group. That also is something that is facilitated by LetsVenture platform.
Thanks a lot, Pallav.
There's one more question, Paris. So just read it out. So it says, example, if a startup founder approaches you directly for investment and you find it investable, do you route it through LetsVenture, or the startup has to come via LetsVenture, or you may opt to invest directly without involvement of LetsVenture? Yeah. Okay, I got the question now. So the question is that uh, a founder, so typically what will happen, Projesh, is that a startup founder will come to some lead investor, right? Sometimes they will come to LetsVenture platform also, but typically, what LetsVenture has been able to do is it has taken a little bit of backseat, and they are letting the lead investors take the front seat in terms of discovering the deal. So typically, if somebody is starting up in the market, they will go to second time entrepreneurs who have done this in the past. A lot of those second time entrepreneurs are syndicate leads on LetsVenture. So the deal discovery, I think all of the deal discovery that has happened for me has happened outside of LetsVenture. What I do then is I say, I'm excited about this. I'm going to put some money in this company, but let us, make it more broad based. See, by the same principle, irrespective of how excited I am on a company, I will not allocate more than 10% of my overall angel investment budget into one company. So I'll say the company needs 2 crore rupees and I'm putting in 10. So where will the balance 1 lakh, 1 crore 90 lakh come from? So LetsVenture is a great bet. So I will kind of then showcase the company on LetsVenture, and more people who are excited about the deal will come together through LetsVenture, and then we'll make a single entity and make an investment into the company. So that is how it works.
Also, Pallav, just want to add to that. So, when we say deal, it's not only about the deal flow, it's also about, a lot of other things that go along with it. And primarily, most of these things are in future, like as Pallav also pointed out earlier, it's about exit management. And then, there is also negotiation on rights. And it is not easy for all investors to go through those large agreements, and then pull out the points to negotiate with the next round of investors. So LetsVenture also comes into that. We also have a history of getting 14, 15 companies acquired, and we have sat on those tables to get those companies acquired to Your Story or Paytms of the world. So essentially that experience also is lended to the lead investor. Obviously he is the cheerleader for all the other investors, and he has much more depth into the company given he's working with the founder. And hence, it becomes important that as an investor who is investing a small amount, you don't get boggled by all those issues. And, we are there to support you. So you can type in, your questions, and, we'll love to put it out so that everybody else can also hear it. And, Pallav and LetsVenture can answer them.
Yes, this question from Mr. Singh: how can a new startup pitch to any lead investor and LetsVenture platform? So I can talk for myself. So I have a lot of people reach out to me on LinkedIn. Um, so you can or you can just drop me a mail on pallav.pandey@gmail.com. So I kind of typically, if not immediately, but eventually, especially if the market is of interest, would respond. And then if all goes well, I can take it up on LetsVenture platform as well. Although most of the times what has happened is, in addition to a combination of market, I have gone and backed founders that have had some past relationship with. So for example, there's a deal that is live right now on LetsVenture platform called Go Flatmates. What the company does is kind of, it helps people discover flatmates with whom they can come together and rent a property. This company is founded by people. One of the guys was my co-founder in my previous venture, and the other guy was the head of operations in my previous venture. So I know them. I've worked with them for 5 years, so I know them in and out about their capability as individuals. So very, very high. And then I also, having been in real estate, I know of this market and I'm excited about this market. So that is why I'm kind of backing this. So a lot of the cold reach outs sometimes don't work, but if you are onto something exciting, or if you're just looking for some feedback, you can definitely reach out to me on the email address that I've just shared. Okay, I've kind of responded to privately. I'll just do it for everybody. Sorry for that.
Anybody else who has questions will love to put it out and answer it both from LetsVenture's point of view as well as Pallav. So Nikhil has a question that how much do you generally invest per deal? Probably it's more related to the kind of stage we get into, Pallav.
So typically, the amount of fundraise that we do ranges from 1.5 crores to about 2.5 crores. Um, so yeah, so so there's another question. So that is the so our fund raise is between 1.5 to 2.5 crore rupees typically. So think about like 200K to like 300 US dollars is the our fundraise range on LetsVenture. Um, the other question is, do you invest in startups hoping to get acquired or to go IPO? So see, so what's very interesting about India is practically no startup has gone to IPO. The market is very hard. So we look for, as early stage investors, we look for startups which can become large in terms of conquering a very exciting market. Uh, and because generally the mental model that I have is to exit it, uh, don't wait till the end to exit, because there is also late stage mortality of deals. So my sense is, if it is a large market, if the founding team is good and they're able to execute well, there'll be backers in the venture world who will be excited about taking this company all the way to IPO. So I will make bets in those companies, and somewhere in the middle of the journey, we would want to take an exit and come out. That is how we think about it. But the companies fundamentally are both a good acquisition candidate and IPO candidates. But we do not wait for that event to happen before exiting.
There is another question, Pallav. Is the focus primarily on Indian startups at this stage?
Yeah, so basically we are okay. We are talking about Indian founders doing stuff. Some of this work is also happening in US market. So there are a company that I'm invested in, which is, there are two companies which are by Indian founders. One company is incorporated in Singapore, called Docquity. I kind of took an exit from it recently, but I was involved from practically from day one on that company. So the other company is again Indian guy, but incorporated in the US and serving the US market, called Ad Pushup. Again, doing exceedingly well. Um, so it can, the market, the target market can vary, but invariably the kind of deal flow that we get is from Indian founders. We do not get deal flow from, US founders.
Uh, Got it, Pallav. So, Ravi has another question sent privately. So, in India, what's the equity structure split in general uh, in between a US and Indian operation? So, primarily, I think what he wants to understand is that how, if it's a US company, is it mirrored or with respect to Indian operations? I hope that is what you are looking to ask, Ravi.
There is always one primary company, right? So you
Yeah.
need to basically hold share, and then everything else gets mirrored. So for example, there's a company that I am running now. It is a Singapore-based company, and it has got a subsidiary in India. So we have given people shareholding, or like a financial benefit in the major holding company, which is a Singapore-based entity, and everything else is just operations and mechanics. So we don't have to worry about it. The legal guys take care of it. But fundamentally, you need to be a shareholder in the uh, in the main company. So if it is in Singapore, you need to be a shareholder either directly or indirectly in Singapore or US or wherever.
Got it. Thanks, Pallav. So next question is, Subbu is new to investing in startups and would like any recommendations on any book that gives more insights.
So I think
Hard thing about hard things.
a hard things is definitely interesting. That is to kind of, I think, more about running the company and what goes inside running the company.
Uh-huh.
So that is, I think, very, very honestly written. But I think there are a lot of blogs by Anderson Horowitz. Um, so you can search for A16Z blogs. So a lot of interesting content around that. So the kind of my worldview around market versus team versus product has actually kind of, I've borrowed heavily from their thought process around it. So I think some of that content can be helpful. There are also some books that have come out recently on venture investing, but honestly, I have not caught up on that primarily because I thought some of those things I've picked up over time without having to go through the books, because the time when we started, the books were not there.
So also adding to that, Pallav, I think, Let's Venture, if you hear the pitches on Let's Venture, for first 3 months, then sort of, so you make your own thesis. It's a great learning in itself, because you get to know a lot of sectors that are getting funded. Second is you get to know how the venture model operates. You can ask questions, you can talk to the founders. So that sort of helps out in your thesis formation, and then post that, you can start deploying capital once you feel a bit more comfort. Praveen has another question. As suggested at series A or B, we want to exit, how does LV collaborate all members of the group if some of are for and some are against? So basically, here the lead takes the call on behalf of the other investors, obviously, after having a conversation with the other investors, but primarily it's lead's prerogative, because he's much more integrated into the company from the board observer side, or probably a director side. Or if lead is not there, primarily 75% of super majority of the investor decide if they have to exit or not. Subbu S has a question. What is the success rate of companies rooted through Let's Venture? So Let's Venture has invested in across 230 odd companies, till now, and we have 75 up rounds. If you see our IRR, it is more than 25% realized and much more unrealized. Ravi again, asked the same question. In India, what's equity structure split in general allocated? So I think, Ravi, the question is not very clear. By equity structure split, probably you mean at angel stage. What is the equity which is generally diluted? If that's the question, it is around 12 to 18%. Krishna has a question. Can angel investors at LetsVenture participate in multiple rounds, perhaps in Series A too, for reasons including avoiding dilution? Just curious. So yeah, every investor, once they invest with the lead investors, or even on their own, they have the pro rata right that comes to them. So if they want to not dilute themselves, they can keep their pro rata by increasing the commensurate investment in the company, and that's where they can avoid dilution. If the company goes down round, which generally are rare cases, companies shut down, then going down round. So in those down round cases, there is anti-dilution which is protected with the founder, which means if the company's valuation drops, the difference of equity is given by the founder rather than the investor. So I hope this answers your question. And yes, there are multiple, Series A rounds also that we are doing, so you can participate in that as well. Mr. Singh has a question. What period of time should an investor on Let's Venture expect for exit on any investment managed by a lead investor? So Pallav, do you want to add to that? I'll also add the perspective here.
So see, I think I tell to anybody who writes an angel check that this is a piece of investment that you do from what I call the play money. So this is like absolutely disposable money that you have in life that you want to have some fun with. So do angel investment with that, because it is super risky. And when you write an angel check, practically forget about it, and it will still come back to you if you do it correctly. But don't count on this coming back, because the liquidity cycles are slightly unpredictable. Personally, what I practice is trying to exit at Series B, but a lot of people choose to do it otherwise. But still, despite your wanting to take an exit from a particular company, you may not have an option to do that. So it is slightly unpredictable when the money comes back. So do it with your absolute disposable money.
Just adding to that, Pallav. So essentially, what we have also seen is that primarily, if you take Series A, Series B numbers, post incorporation of the company, it takes about 12 months to do an angel round. And then, you know, it takes about on a median basis 22 months to do a Series A, and then, you know, another 26 months to do, you know, a Series B. So and these are median numbers, you know, some of the numbers will lie on either side. So you will see that at least, you know, 4 years are there, you know, since the angel round, you know, to get to Series A on median basis. Uh, and hence, you know, 4 to 6 years is what generally the timeline is like for companies who reach, you know, their Series B stage. And uh, by that time, either the company will run out and probably, you know, get acquired, or they will at least, you know, get to the Series B numbers, or get shut down. So these are the three possibilities that generally emerge, you know, within that time frame. Mr. Singh has, yeah, I think that was answered. So I think we are dot on time. Soumya has one last question. Is there a reason multiple syndicate heads don't invest in the same company? So, Soumya, so basically, you know, different syndicates also invest along with each other, but there is only one lead which is in the syndicate, you know, and hence it's managed by, you know, that particular lead.
Really, I would say, you know, जैसे एक म्यान में दो तलवारें नहीं रह सकती, right?
Yeah.
वैसे एक डील में दो syndicate lead नहीं आते. So it was very logistically very complex to have two in the same deal.
Yeah. Cool then. Thanks a lot, Pallav. Thanks everybody for joining in. Uh, you know, you can reach out to Pallav as well as at any point in time. Pallav has shared his email on the chat, and you can reach us at deals@letsventure.com. Thanks again, Pallav, for taking out the time.
Absolute pleasure.
For us.
Thank you, guys. Thanks,
Thank you.
everyone. Yeah. Bye.